Hello, everyone. I'm Arvind Agarwal, founder and CEO of C4D Partners.
Broadly speaking, you can classify equity investors into two buckets: those who invest in public markets and those who invest in private equity. As an example, a mutual fund is a public market investor that invests in listed stocks. Private equity investors are further split into two broad buckets as PE investors and VC investors. By the end of this episode of the Founder Thesis podcast, you will have a deeper understanding of the difference between a PE investor and a VC investor, and you will also understand the mind of the PE investor. Arvind Agarwal is a veteran PE investor who is marrying his deep experience as a PE investor with impact investing, which is basically the practice of investing in companies that are creating social or environmental impact. Stay tuned for Akshay's fascinating conversation with Arvind Agarwal, in which he learns how to think like a PE investor.
So you've been a veteran of the PE VC space. Just take us through your career path. What led up to you starting your own fund?
Sure. So I'm not sure about the veteran, but definitely sure about my experience in the PE space, but not the VC because, in my mind, there's a very clear distinction between the two strategies. My journey started quite some time back, Akshay. I was 15, and I come from a moderately economic background and from a very small town called Purulia. And at the age of 15, things were financially not looking that great, and I was looking for an escape route. And that's where I stumbled upon an English newspaper. And the front page of that had a article about a private equity firm. I don't remember the name. I don't remember the name of the person, the picture I saw. But that person looked, quite happy to me and rich. And at the age of 15, these are the two things I wanted. I wanted to be happy, I wanted to be rich. This was the era, no internet. And in my mind, I decided I'll be a private equity professional. Didn't know how.
Fascinating, fascinating.
And the
I'd like
journey.
to share one quick anecdote here. I have interviewed another VC fund founder, and he had a very similar story that he watched Pretty Woman, and the character of Richard Gere in Pretty Woman is like a PE fund guy, and that is what influenced him. So this seems to be some sort of common theme between people who get into the PE VC space.
Yeah, this was the era we didn't have access to English movies, so maybe I would have been inspired much before than the age of
Yeah.
15. But yes, the
Yeah.
journey started from there. It's been 28 years now.
Wow. Okay. So just like a quick summary, what organizations, what roles, what did you learn in each of those?
So after my post graduation, I joined eValueServe India Private Limited. It's a third party research organization based out of headquartered in Gurgaon. There, I was doing research for two Asian based private equity firms. This was an outsourced research, so researching on the companies they are looking at. This was a short stint, and then I moved to Goldman Sachs Private Equity Group. This was 2007. That was my longest part in my
How did
career.
you crack Goldman Sachs? I would have thought you would need like some pedigree of like an IIM tag and all of that.
Yeah, so that was also an interesting episode, Akshay, because a lot of people applied for, and it was a founding team which was put together by Goldman Sachs in Bangalore in 2007. The idea was that this team will kind of be a back office for the main teams which are sitting across the globe. When I applied for Goldman Sachs, it was a long drawn process, 5 rounds of interviews, and then after 10 days, I received a call saying, "Hey, you didn't make it."
Okay.
So obviously I was rejected because Goldman Sachs was one place I wanted to be. Then after a week or 10 days, I received the call again from the consultant, and she says, "Hey, you made it." I like, what happened? They said, "No, they were hiring three people. You were the fourth one, and one of the three people declined to take the offer. So it went to you."
Mm.
and super excited and joined, and very quickly in 3 months the roles changed from just being a captive. It become more like diligencing the funds, researching the funds, working with the fund managers. So if I think on day one, if the objective was that it will be a front ending team, probably I would not have made it, because I don't have a IM or a Ivy League tag with me, which usually you see with people in this part of the world.
Mm. Okay. And what was your role there at Goldman Sachs? What did you do?
So I joined as a senior analyst, and primarily this department used to look at investing in fund managers. So we were investing in funds across the globe and direct co-investments. I did that for 4 years, and then moved to hedge fund of funds, where working with
So
the hedge
Goldman
fund.
Sachs had its own fund which was deploying the strategy.
It was Goldman Sachs' own fund of fund. So just like a GP, they had raised money from big LPs for this fund of fund, and the main objective was to invest in private equity and private equity funds and hedge funds.
Mm. Okay. So this would be like creating an index fund in a way.
Not an index fund as such, but it is like a creating a fund, mutual fund, raising money from endowments and
Right.
insurance companies, and then investing in fund managers.
Okay. One quick clarification before you tell me about the hedge fund role you did at Goldman. You said that there is a very clear demarcation between private equity and VC. What is that demarcation? Because the very same company on its cap table might have Sequoia, which is clearly a VC, and might also have maybe, I guess, General Atlantic would be like a PE, or so or like maybe Westbridge would be a PE. I don't know. I mean, I'm not fully clear, but I know that on the cap table of one startup, both can exist in parallel. So, what is the clear demarcation between a PE and a VC?
See, both can definitely exist in the cap table of a company. It's about the role or the strategy one's execute. The line between P and VC is getting blurred day by day. So if you look at traditionally what used to happen as company starts, and they were raising money from friends and family, angel round, and then they approach a VC fund. VC takes the largest risk at that point in time with a higher check, because the product is not ready, and most of this investment is going to create the product. Technology and VC kind of goes hand in hand. So it was always funding for the development of the tech product. And once the product hits the market and company turns profitable, it's cash flow positive, a PE walks in with a larger check for growth of the company. Now, what has happened is, if you, particularly if you see in India, we see invest, and it's not to fund the product development, which is a technology play, but it is more to fund the OPEX losses. And this has become a never ending process. So, if the company is not operating cash flow positive, a PE will not walk in, and which is why you see now larger VC funds, and they call themselves late stage VC. And another interesting thing which is happening here is a lot of PE funds are now saying, "Hey, we are losing out on opportunities because most of the deals which are going to the growth stage, we can't do it. It's not cash flow positive." So there's this concept of early stage private equity which has cropped up,
Okay.
where
Okay.
PE kind of comes in early stage. And if you look at us, we are also an early stage private equity fund.
Okay, interesting. So you're saying traditionally a PE looks at cash flow positive businesses. So it's looking at the business the way a public market investor is looking at a business. The fundamentally strong, profitable business which will give a reasonable return on investment. It's not taking like big bets that okay, I will invest in 20, and out of them one big bet will happen and it'll make up for the 19 bad bets. That's
Yeah,
not what a PE
so
does.
exactly. So just number is slightly different. A P usually works in a fund 15 to 20 companies, and all the companies are as important as any other company in the portfolio, because they can't tend to lose portfolio companies from their bucket of the portfolio, and one or two will go down, but majority of the portfolio will drive the return for the fund. Whereas in a VC, if you see, it's more of a spray and pray, where you will probably do 40 transaction, and you will pray that four of the 40 turns out really well, and that will kind of recoup all the returns for the other. investment that has gone down. So it's also about the focus, and which is why PE funds focus quite a lot with respect to operations, management, strategy. That's another reason why they can't have a larger portfolio, because it's very difficult to be operationally and strategically involved with a large set of companies in your portfolio.
Right. Okay. So a PE fund would want uh, to carefully look at numbers and advise management based on what they see on the numbers, and like take a more active role as a consultant to the founder or the leadership team. Okay. How you were responsible for deciding which fund manager to back at Goldman Sachs. What's the way in which you evaluated and took that decision?
So actually, the analysis, split into two parts. One is the qualitative, and the other is the quantitative. On the quantitative, we look at the past performance. There is a lot of slice and dice which is done with respect to the portfolio companies of the previous funds to understand which partner, which geography, which sector, which strategy kind of worked for the fund and against the fund, and a lot of those type of analysis is done, including value creation. So, unlike a VC fund in private equity, it's all about the operational efficiency and the operational growth. So, we do something called value creation analysis, where we try to understand how the value was created in the company. Was it by increasing the EBITDA, or is it just by reducing the net debt, or it is just increasing the multiple of EBITDA or revenue that we are using? So a lot of those type of quantitative analysis happens, and then qualitative, to understand the market, the strategy which the fund manager is executing, the team strength, things like that. So these are a set of two analysis that we do to understand which fund manager to back versus which to ignore.
And is there also a consideration that, okay, we already have one fund manager who's focused on tech startups in India, so we will not back another fund which is on the same, like diversification?
So high level diversification happens. So the way fund of fund also works, because just like a fund, there is a strategy of the fund of fund. So fund of fund will not say, hey, I'll just pick one of each. So the fund of fund strategy could be backing tech VC funds in India, right? So there's some diversification might come with respect to sectors, subsectors, but that not be huge. So if all the 20 or 25 fund managers in that fund of fund would be tech VC. Some might be deep tech, some might be working on health tech, things like that. But all will be quite similar with respect to tech exposure.
Okay, okay. And so after the first 4 years, you said that you went into a separate division. What was that?
So after first 4 years, I went into the hedge fund of funds division of Goldman Sachs, and here also, so a bit of a background here, which is very important to where we are today as a country when it comes to private investment. So this team was put together in 2007, and and that was a time when the idea was that private equity in India will become big. We joined in May, and if you remember, there was a financial crisis which happened 2007 December and 2008 January. Unfortunately, at that point in time, a lot of PE funds in India, they had a high amount of exposure with respect to public investments, which is in our language called PIPE, private investments in public enterprises. 2008, when the crisis happened, a lot of these fund managers kind of doubled down on their public investments, and as you would know, the markets remained choppy for a couple of years after that, and that led to a bad reputation for private equity in India, and private equity didn't grow as it should have grown in the past decade. Then for us, it was more of working with fund managers outside of India, and that was not the main objective of the team which was put together. And that's when in 2011, Goldman Sachs was kind of deciding to shut down the team for private equity in India, and that's where I moved to hedge fund of funds. Public market was growing, though hedge fund again in India is not big. but globally it's a very big market, and that's how I moved to hedge fund.
What's a
Now,
hedge fund?
so hedge fund can have different strategies. There are four broad strategies that you see hedge fund managers execute, but it's mainly dealing with public markets. So you can be dealing in debt instrument, currency could be one strategy, equities. You have different strategies. So it's largely two key aspects, I would say. One is public market, and two, these are very high risk bets. So unless a P fund, where if you have $1, you invest $1, a hedge fund will invest $100 when they have $1. So you can see your entire capital wipe out in a day, or you could make 100% return in a day.
Okay, okay. So they would take more leveraged bets using like options and futures. Okay, okay. Hindenburg, which had gone after Adani, is also a hedge fund.
No, it's not a hedge fund. It's more of a, I don't know, it's a mixed terminology you can give them, because one, they call themselves a research organization where they kind of do these type of research, but Hindenburg, they actually take an exposure before making the research public. So there is a vested interest as well, right? So they don't do typical hedge fund work, but this what happened on the Adani episode. This is more of a, you can do better research, but before you make your research public, you will take your own bet. So you also gain advantage, not just because of the research, but also the market sentiment that you are creating.
Okay, okay, okay. Plus, it gives you skin in the game in a way. Like your research will be seen as more credible if you're putting money behind it.
Yeah, but hedge fund managers, on the other hand, they have their own research when they take their bet, but they never make that research public.
Okay, got it. Okay, okay. I think there was another Wirecard in Europe. I remember reading an article about how a hedge fund ultimately kind of exposed them. They had done deep research and discovered that Wirecard was a fraud.
Yeah,
Yes.
hedge fund is a, I don't know how to what should be the right word, but it's a very difficult and sketchy business as such, because of the strategy they follow and the type of returns they make. I mean, they're not one. There are many instances in the past which has happened where hedge funds are total fraud with respect to how they operate and all, and not all hedge fund managers, right? But the probability of something happening wrong is quite high, given how close they keep the cards to their chest about their strategy, what they are doing, their transactions. So a lot of I think for them it's very important, for a lot of transaction, that the information don't go out, and for a lot of transaction it makes sense that the information go out.
Okay, got it. Right. Okay. So then you were into fund of hedge funds, like you were backing hedge fund managers for Goldman Sachs.
Yes, so that was again a short stint, and by that time I was already too much into private equity. So it was, then the question which came to my mind: what's important to me, what I do or where I do? And what I do was more important than where. So I started looking out, and then shifted to Middle East, Abu Dhabi, and joined a local private equity fund manager based out of Abu Dhabi. Would not have ever left Goldman Sachs, because that was one organization I really enjoyed my time. So if it was not for the fact that the private equity is shutting down in India, I would have probably remained there. But private equity kind of, by that time, it was more than a dream of a 15-year-old child. It was something I was thoroughly enjoying.
Okay. Okay. So and that Abu Dhabi PE was investing where, like in India, or
No, not India. So we were investing in GCC countries. Direct investments were done through one of the funds. We were also doing real estate investments in UAE and also London. So we had a listed entity in London. And third, we had what we called a secondaries fund of fund. So the secondary fund of fund is different from a primary fund of fund in the aspect that a primary fund of fund is when I invest in a new fund. A manager is launching. It could be their third fund, fourth fund, but I am an investor from day one. And as you know, private equity investments are illiquid. You are locked in for 8, 9, 10 years. Secondaries fund of fund actually buys the LP stake of an existing fund. So we also had a secondaries fund of fund at Goldman Sachs and at Abu Dhabi Capital Management, where we used to buy the LP stakes of other funds.
And you would probably get some discount in return because you're providing
So
liquidity.
Depending on the quality of the fund managers, the discount could vary from 90% to even a premium. So there are some cases where we actually gave a premium, but
Okay.
largely you would see a discount of 40, 50, 60% when buying the stake.
Okay. Okay. Interesting. Okay. Okay. Right. Then what next after the Abu Dhabi stint?
Again, it was a short stint because though I was enjoying my work, but the work culture in UAE is something which I was not able to gel well. And after some 13, 14 months, I decided I was quite done. It was almost 8, 9 years, and P space is it takes a toll on your health, be it physical or mental. And I was at a stage in life where I was like, I've already worked for 16, 17 years. 8 year was equivalent to 16, 17. I said, let me go back to my hometown and try to do something of my own. And I went back to Dhanbad, which again I call hometown, but that's not where I am born and brought up. It's just my family, siblings, and my parents. They moved. I was born in Bengal, so I moved to Dhanbad and I started a rural BPO. So I went there and I, kind of started looking around what to do. Realized there's a big population of youngsters who are graduates, who are engineers, and they are working in Calcutta. And at that time, most of these people were getting a salary of 15,000, 12,000 a month, where almost 60, 70% they were spending on food and housing. They would have any day wanted to work in their hometown where their families are and work for as 5,000, 6,000, 7,000. And these people were computer literate, so easily they can do conversion work, non voice processes. So I started that, and it was a total failure. 13 months I tried to establish a business, yeah, but didn't succeed. And
Was it
after,
that you were not able to get business, or was it that you were not able to execute?
so it was mix of challenges, Akshay. One, I was a single person, kind of do everything with respect to operations, business development, getting new clients. The business community, or the way business work in Eastern India, is very different than what we are used to. Right, being in the PE space all my career at that time, there are certain level of expectations, there are certain level of commitment which are not to be said. Eastern India is a very different business community. So that was
But
also one
you
of the.
you could have got business from even an Airtel or any national player, because this is like.
Yes, we were actually. I was trying all those things. In fact, that was a time when post office digitization was happening. So all the post office records were getting digitized. FIRs were getting digitized. Unfortunately, all these contracts you can only get as a subcontract. You're not a big player to get a main contract. And when you get a subcontract, which is what I had, you are dependent on the main contractor with respect to your payment. And the way they take decisions with respect to how much they are going to pay you and when, and whether they are going to pay you or not, it's very different business.
Yeah, 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 yeah. I can imagine that's a cash flow challenging business. I mean, working with government is profitable but cash flow challenging.
Yeah, and this was not also directly working with the government. It's like
Yeah,
with
yeah,
the
yeah. The
contractor, so
profit would
they are.
have eaten. Yeah, yeah, yeah.
Exactly.
They would
And
have
plus,
eaten up
they
the
will
profit.
then not pay you on time, or they will not pay you at all. And one invoice not getting paid, you're losing too much money.
Right, right, right. Okay, got it. Okay. So, what then? Like once you tasted failure.
Yes, I tasted failure, but I I think of all my career, the 10 years that I spent, this was 1.5 years where I enjoyed the most. I mean, surprisingly, every day was a challenge, but every day I was happier. So, I realized that this is where the uh, happiness lies for me, or this is what I enjoy the most. So then the idea was, how do I merge the two things that I really like in my life? One is investing, and the other is early stage. And at that time, I also realized, Akshay, because see, when I joined my first job, eValue Serve, it was a 1.5 year old organization, so pretty much kind of a startup. Goldman Sachs was a organization which has been there for ages, but this was a new team which was set up in Bangalore. Similarly, my Abu Dhabi, I joined them, and it was a 1 year old organization. So somehow I was in that zone of 1 2 years type of older organization or team, and that's what I realized when I failed in my venture, that this is one space I enjoy. So I started looking out to see if I can merge the two. And there has been a gradual decrease with respect to check size. So in Goldman Sachs, the average check size was 50 to $100 million. At Abu Dhabi, the average check size was $5 to $10 million. So then I started looking for opportunities, and that's when I came across you know Eco Investments, which is a former name of C4D Partners. Check size $500,000, early stage investing, working very closely with the founders. And I thought, this is something which is kind of ticking both the boxes. But at the same time, 1 year stint which I had in Dhanbad, I also realized, the impact that these businesses can make. Right, I hired 15 people in my organization. All 15 were very happy. I was not able to pay them for the first 2 months, and they still turned up for the third month. They said, "No, no, we want you to be successful, because if you are not successful, we will have to go back to Calcutta, and we don't want to have that life." In fact, after a year, when I shut down and I joined Eco, some of those employees kept on calling, "Are you thinking of doing something else in Dhanbad? We would really like to come." So that was another angle which I understood. To be honest, before that, I didn't understand. This angle, writing a 50 to 100 million check and being at Goldman Sachs, you don't really understand what goes on the ground with respect to rural. So, Eco Investments, or C4D Partners, 2014, it kind of ticked that box as well. And that's where my new journey of impact investing started.
What was the thesis of Eco?
So, Eco, it's a Dutch NGO, and primary funding for them was the Ministry of Foreign Affairs in the Netherlands. So it used to be a 5 year budgeting, and they used to get money from the government to execute project. In 2010, they already knew that the next year budget, the next that is 2015 budget, is going to be significantly lower. So they wanted to diversify businesses. So they started an investing arm called Impact Investing, Eco Investment, with the idea that this fund will support private companies, which will help with their projects that they are running in the country. So it was very much internal looking strategy which was that for Eco. And Eco Investments was a subsidiary which I joined in 2014. However, soon we realized this is not doable. Investing has to be disciplined, and it has to have its own autonomy. You can't invest money with an objective of working or supporting a project, not for profit project, for the organization. And 2016 we realized this, and 2017 I kind of spun out of Eco and became an independent fund manager. That's where the name changed to C4D Partners, or Capital for Development Partners.
And what does it mean to spin out? Like you bought out their share, or like what does that mean when you say you spun out?
Yes, so basically 100% ownership earlier was with Eco Corporation, and then I kind of bought out the shares, and it 100% shareholding came to the team.
Okay. And you had other co-founders with you.
Yes, so I had other co-founders from the Netherlands, who were part of Eco Corporation at that time, and they also, so the entire team kind of came out, and me and my partners kind of acquired the shares.
Okay. Yeah, and I'm guessing this would have been nominally priced. They would have.
Nominally price, yes,
Right, right. Because their goal is to make it a success rather than to uh, get a return on. Got it. Okay,
that's
okay.
correct. Yes.
And some corpus also came along with that. You had a
Yes,
corpus to
so
invest.
before that, we were investing from the balance sheet of Eco Corporation, and at that time we also kind of realized, because we were trying to fundraise in that fund which was there by Eco Corporation, and there were three challenges we realized. So it was, at that time, it was a global fund. We were investing in Africa, Latin America, South Asia, Southeast Asia. So when we started talking to LPs, three main concerns came. One, the ownership of the asset management entities with another institution, and that's where we kind of spun out. The second was a global
Like
fund. So
LPs want the fund manager to have skin in the game,
yes. So, because
and
if the
that
LPs,
was not the case.
yes,
Hmm.
that was not the case. If GP is not owning the entity, they will leave any point in time, and that puts
Right.
the fund or the investment at risk. The second was a global fund. So, none of the LPs were ready to invest in a fund which was investing globally. It was too wide spread. So, that's when we also decided that we will not invest globally. We kind of shut down operations in Africa, Latin America. We cut down a lot of countries in Asia, and we said we'll focus on three countries: India, Indonesia, and Philippines. The third concern at that time was that it's a open-ended fund. So the fund which we were trying to raise money for, that didn't have a fund life. It was, kind of a company structure, you could say. So that's when we also kind of launched our first closed-ended fund in 2017. So these were the three main concerns which we addressed, and we closed our first fund in 2018, a $30 million fund.
Okay, amazing. And this $30 million was from what kind of LPs or limited partners? And just for listeners, so like a limited partner is the one who gives money to the fund manager, and the fund manager invests it on behalf of the limited partner, and in return, the fund manager gets to keep some amount of profit share plus some management fees on based on how much money he is managing.
That's correct. So LP kind of invest in the fund which is managed by the GP or the general partner, and they're entitled to a management fee for running the operations and a share in the profit which is generated by the fund.
And typically, management fees is like a 1-2% kind of a
Depending on
number,
the
I
size of
guess.
the fund, yes, it ranges between 1 and 2%.
And the profit share is, I think, about 20% or something like that, in that range.
So traditionally 20%, but now depending on, so you see a lot of different combination, and I'm talking about really successful big funds where you would see that some manager will say, "Hey, I'll charge 1% fee because it's a big fund, but I'll charge 30% carried interest or the profit share." So that is something also you see quite a lot.
Okay, okay. And typically, there's a like a hurdle rate you have to cross. Like you have to generate some minimum return on investment before you are entitled to a profit share.
Yes. So there is a hurdle rate always with respect to the profit share, and it could again range between 8 to 10% is what you have to first generate return for the LPs. Once you have crossed that hurdle, that's when you are entitled to take the profit share.
And uh, how is the return calculated? Because if these are not publicly listed assets, like you could put any number on it in a way. So how do you calculate the returns?
Yeah, I think we can do a separate podcast just on this topic. How do the valuation of these companies work? See, for private equity, it's relatively easier because, as I said, these are cash flow driven transactions. So when there is stable cash flow, the valuation becomes more or less, you can have a ballpark figure. You will never be accurate, but the ballpark figure will be, good to use. The challenge is when it's a VC portfolio, then the creativity that you can have with respect to valuation of these investments is quite wide. So I often say this, when we were growing up and studying, there's this terminology or this line you always heard, that valuation is more of an art than a science. In current scenario, it is just art. Science has gone out of the window. So the bigger artist you are, the better valuation you can get. But having said that, and which is why the need of auditors also come in for kind of checking or cross checking the valuation and agreeing largely these are fine. But again, for anybody, be it the fund manager or the auditor or be the LP or anybody else, saying what is the right valuation, I think the investor in that company is the right person to say, as long as uh, they are not being too artistic. I think they are the one who will get the valuation right. But yes, there are a lot of gray area when it comes to valuation. But sooner or later, this is going to come out, right? If you are, if you put a very high valuation on the paper for a lot of your companies today, it will going to hit you tomorrow. So it's not like you'll get away with it in the short term. Maybe you will get away with it, but in the medium to long term, it will bite you back. And if, as an LP, for example, when we were talking about my Goldman Sachs days, as an LP, if I see that this is what is happening for the all the funds in the past for that fund manager, so that is also an underwriting condition that we look at, that okay, this manager has a habit of allocating a crazy amount of valuation in the past to have a high NAV. So yeah, that also works for your longer term, where it will not help you.
Okay, got it, got it. So this 30 million that you raised for your fund one was from what kind of LPs? Indian LPs, or did you go global? And what
Mm,
was the? And this was like an impact investing focused fund. So you would have pitched to LPs that your money will create impact.
Yes, so see, so first maybe LPs were non-Indian because this fund was registered in the Netherlands and it would have been difficult for Indian LPs to invest. We raised money from Dutch DFI, Dutch Good Growth Fund. Eco Corporation also became our LP in the fund, and the third LP was Finchurch Aid, a fund by Finnish government, and the fourth was Investing for Women, another fund by Australian government. So these were the four investors that joined us in our journey. For me, because I came from a private equity background, and the first 4 years in the space, I kind of observed what is happening and how the space is shaping up. So this is what I noticed. When I joined in 2014, this was my first exposure to impact investing, and that time the shift was happening from not-for-profit or grant making to impact investing. A lot of organizations were kind of reorganizing themselves to do impact investing. However, a lot of underwriting at that point was still done by people from the not-for-profit sector because the space was not big, the salaries were not high, and a lot of professionals in the investing space didn't wanted to join. In fact, when I also joined in 2014, I took a 70% cut on my 2 years salary, which was 2 years back. So that time I realized a lot of underwriting is happening with respect to project perspective, 3 years, 4 years vision, and that created an issue with respect to one, that the social enterprises or impact investing is not scalable and it is not profitable. The only sector which proved with respect to performance was financial inclusion, that got money from grant impact. Commercial investor went for IPOs, and now you see financial institution or investors in financial institutions are kind of repeating what has been done and trying to make money. But
And
this
this
was a
you're talking
period.
of MFIs.
MFIs, yes.
Hmm, hmm,
And
right. Okay.
so which is why that was a period 2014 to 18. I also saw LPs or investor forcing the GPs to move beyond financial institution or MFIs. That's when other sectors open up, like agriculture, education, healthcare. Now, unfortunately, by that time, you saw a lot of professionals coming in, and a smaller fund size, and it was all early stage investing. And by default, the strategy these funds adopted was that of a VC. Right, so we'll invest in this many companies. It was more of underwriting with respect to top line and not cash flow positive. See, these companies are not going to raise money every year. When you are working on bringing about systematic change to something, it takes more time. And this is not like all of a sudden tomorrow you'll start getting commercial capital. So that kind of created an issue where scalability and exits were not happening in all these sectors, and which is where the shift all of a sudden became a VC type of play, and then everything has to have technology. So there was no talk about education as well, edtech. There was no talk about healthcare. Now it is health tech, and so on and so forth. When we did our fund, what we wanted to prove with respect to strategy was that to be successful in India in early stage investing, particularly when you look at impact investing, you have to adopt more of a private equity approach than a VC approach. So, our all our underwriting was from a private equity lens. The companies might not be profitable, but they have clear path to profitability in the next 12 months. And then there is a balance between growth and profitability. It'll take more time, yes, but we are not going to lose companies because they are not financially sustainable, and which we were able to prove. So the strategy was completely woven around how do you execute a portfolio. And coming back to your point also, so one, if you don't lose a lot of companies, you're not losing the impact those companies are creating. Two, if you're not taking unnecessary risk and the portfolio construction, so if our portfolio construction is that we don't lose more than 20% of the portfolio, which is also typically you see in a P. There will be 30-40% of the portfolio where the growth will not be exponential. They will not raise money year after year, but these are cash flow positive companies. So you can still get an exit through management buyout, where you try to recoup the capital at least, and if possible, also the hurdle rate. And we, in our portfolio of 13 companies in India, already have done four such exits where it's a management buyout. The third set of the portfolio is the ones which are growing exponentially, raising capital, every 12 or 18 months. But these are cash flow positive as well, not losing money, profitable companies, but faster growth. There you will exit through financial or a strategic buyer, again making an IRR in the range of 30 to 40%. So if you are only losing 20% of the companies, getting capital and hurdle recouped from the second bucket, and a 30-35% IRR from the third bucket, at the fund level, you can easily do an IRR of 25%, which, by the way, is a struggle for most of the VC fund also. Right. So if you take out the top quartile VC funds, which are pure play tech type of play, you will see that 25% is struggle. So you don't have to do anything crazy. It's because this is one thing which I learned in my short stint in my hometown, where I was working on the rural BPO. At that time, when I put in investment, I was kind of calculating in my mind that if I have a 10-seater BPO, what is my net profit? And I was looking, if I have a 20-seater BPO, then what is my net profit? So I was looking at the upside. I was not focusing on the downside. I would have been much better if I had a 5-seater or a 2-seater BPO. So that's where I realized that it's all about protecting your downside, and then you work on creating the upside.
Okay. Okay. Interesting. These The 30 million, how long did it take you to deploy it? Or are you still on fund one, or have you deployed that?
So we are almost fully deployed. We have deployed. We have a very small dry powder, which is for follow-on investments. We were last year, by late last year, we were completely deployed with 10-15% of the capital left for follow-on. That's when we launched our second fund. Unlike our first fund, which was investing in three countries, second fund is 100% India dedicated, $75 million fund, which we are raising right now. It's the strategy with respect to the portfolio construction, our thinking remains the same. The beginning or the initial check size also remains the same. It's the higher end of the check size which will change because of the fund size. And our existing investor has also committed to invest in that fund.
And existing investors alone won't be enough, right? Because this is like
It won't
more
be
than
enough.
double of the last fund you raised, so you
Yes,
would
yes.
need to. And you'd be looking at similar kind of LPs, like uh, uh, sovereign wealth funds and like these kind of funds which have a
No,
development agenda, or
I mean, sovereign wealth fund and all, usually are quite big. So it's more of a, what we call the development financial institutions, which are usually put together by the individual countries. They have more of a development agenda, and see, for us, getting the right LP is also very important because what we also did on day one, we wanted to change the status quo with respect to how people look at the structure of a fund, as we were discussing earlier, right? 2% fee, 20% carried interest, 10 years fund life, 5 years investment period. It has become so standard. Nobody is applying or thinking that whether this is what the market needs in India. This is something which worked in the West, and we blindly copy pasted this to India. So one of the things which we did in 2018 when we had the first one, we linked our gender goals. So we have a strong focus on gender investing. We committed that 30% at least of the portfolio or the AUM has to be invested in women-owned led enterprises. If we are less than 30%, then we lose carry percentage, and if we are more than 30%, then we gain carry percentage. In our first fund, we have invested 42% of the AUM in women-owned led enterprises, which means we are at a carry of 25%. So it's very important for us to reach out to the right set of LPs who are ready to, bring this systematic change when it comes to the structuring of impact funds. So we are mindful about, which are the LPs that we are reaching out to who would be ready to make these type of changes in the fund structuring for impact investing.
okay, okay. Uh, Would you also be targeting, like, say, the Bill and Melinda Gates Foundation, and I think there's a Michael Dell Foundation, and such, like such philanthropic arms of billionaires?
Yes, so apart from DFIs, we are targeting foundations as well. Those also have good orientation. But however, we are very clear, we will not take any grant money in the fund. It has to be, every LP in the fund has to be on equal footing. So there are a lot of foundations we are in discussion with. As a next step, once we have had the first closing, we would also like to see the Indian family offices join, because that's another big pool where the orientation of impact investing is still not there. Because if the family offices don't start looking at impact investing, then I think the impact funds will be largely dependent on foreign capital, which is not the right thing in the longer term as well.
Why isn't impact investing mainstream? You explained to me that you're able to generate a 25% IRR, or internal rate of return, which you told me is more than what the bulk of funds are able to generate. So I mean, you're actually in like the top percentile in terms of IRR. Why isn't this mainstream? I mean, what's
So
holding it back?
Multiple reasons, Akshay. As I said, there was this period between 2014 to 2019 where a lot of money flew into impact investing, and the way it was executed earlier didn't turn out well, and I call those teething problem. And then all of a sudden, impact investing became VC investing. It should have been other way around. The VC investing should have become impact investing, but impact investing kind of became VC investing, and everybody started clapping. Hey, the two worlds have merged. So it's not two worlds have merged; it's you cease to exist kind of a situation. So there are two sets of investors, I would say. One who are disappointed that something like this has happened, where there is no longer any impact fund and it all moved towards VC investing. And the second set who wants to focus more on the commercial side of things. So we kind of, the sector lost both. I go to somebody who is into impact investing. The moment I call we have an impact fund, they will like always question one, either you will fail to deliver with respect to impact and a decent financial performance, or I am going to operate like a VC in the garb of impact investing.
Mm, okay, got it, got it. Uh, is an ESG fund similar to an impact fund? And ESG stands for environment, social governance, and these are funds which are investing. I guess the difference with these funds typically do public market investing, right? They don't do private market investing. An ESG fund.
No, actually, so first thing first, ESG and impact investing are two completely different things, and there was a lot of interchange. People were using both these terms interchangeably quite a lot, and which forced me to write an article around it where I says ESG investing
Okay.
is not impact investing. Okay,
What
and
is
I
the
listed
difference?
out.
Can you? Yeah.
So there are a lot of differences. See, when ESG investing is more about assessing your risk. When you're investing in a company, so you look at, and which is why you see, a lot of public companies falling into that purview of ESG, because it's large corporates, large companies. The impact on E, S, or G could be significant. When you're talking about early stage investing, companies that are 1 year, two
So
years, 3 years.
one second, sorry. So an ESG investing thesis is that uh, companies which today might have similar cash flows or similar EBITDA percentages
Mhm.
would in future differ based on how much they are cognizant of ESG risks. So a company which, like, both companies are earning the same amount of cash, but if one company is more cognizant of ESG risk, then it has a brighter future. So you invest in those companies which are cognizant of what is the environmental risk of their business, or the social risk, or the governance levels. That's the thesis.
That's the thesis, yes. When it, you look at the higher level, but this is when we look at ESG versus impact investing. ESG is more backward looking. You look at how the company has been operating in the past years and what are the ESG risks, and you try to minimize those risks going forward, which could have a business implication in the longer term. Whereas impact investing is more forward looking. You proactively take actions to achieve a particular goal. Unlike ESG, which is very generic, you need to kind of take care of a lot of things. Impact investing, for example, for us, it is the focus is genderless investing. So that's our key focus, that we need to bring diversity when it comes to the organizations in or the fund managers investing in companies, or the companies which we are investing in, the supply chain, right? That's our focus. That's the impact that we want to create. Somebody might have an impact with respect to working with blue collar workers, that we have to give them a dignified life, minimum living wages, things like that. So you can have any impact criteria given the problem that you want to solve. Whereas ESG, you'll have to look at holistically everything. Now, see what happens is, uh, most of the bigger organization, it's easier for them to kind of make this assessment, invest for the future when it comes to ESG. Early stage investing or early stage companies, if you sit with them, they're trying to sustain on a daily basis, and you say, hey, this is how you have to be operating with respect to ESG. It doesn't work, and we realize that, which is why we it took us a year, and we developed our own toolkit around ESG, to ensure that it is not binary. It's not that you are either doing this or not doing this, and give them a roadmap for the next 5 years, saying, okay, this is what you could do in the next 5 years to increase your ESG scorecard. Now, because impact investing was very specific, and a lot of people failed to deliver those specific results, they kind of used ESG as a better tool where it is so generic. It's very difficult for anybody to tell that you failed or you succeeded in delivering what you said. So it's unfortunate, at least in my opinion, it was a strategy to kind of paint everything so generic that it's very difficult to question anybody. And this was also, it made a lot of sense for larger funds doing large investment to be ESG compliant. But a small fund, 100 million, 200 million type of fund size, or 500 million, saying we have an ESG strategy, that's sad.
Got it. Okay. Uh, Impact investing is essentially, and there could be two ways of looking at it. One is uh, you are investing in companies which are creating some sort of positive social impact, like say generating employment, or let's say mobility, making it easier for access, or opening up markets, or bringing in transparency, or helping, let's say, farmers with price discovery, cutting out middlemen, those kind of businesses. Or the other could be you are investing in like say women, irrespective of what their business is. It could be a woman who is doing a, let's say, who's building a SaaS product for banks to use. There is, you could can't really say it's like there is any impact angle in it, but because it's a woman founder, so you would invest, and that would qualify as impact investing. Like, what's the way to think about what is impact investing?
So the good and the bad thing about impact investing is there is no set definition what is impact investing. Okay. The good thing is, because you see a problem and you want to solve it, you can solve it. You can have a definition for yourself for that problem that you are solving, and which is also the worst thing about impact investing. Since there is no definition, anybody can call anything impact investing. So it's a double-edged sword. To your question, see, for us, at least, both has to matter, or both has to tick. So one, it has to, we need to see that a minimum percentage of the portfolio is women owned led, which is representation in the portfolio. But we also need to ensure the second level, which is the impact with respect to livelihood and environment. So we invest in businesses which are either rural focus or focused towards marginalized communities in urban India. But again, having said that, the thesis is very clear. So we will, it's investing end of the day, and then there is impact. So it's impact investing, which both has to balance out. So the way we have looked at things, Akshay, is if you are able to find a business model which is solving a societal problem, and the business model is woven around a societal problem, so that both are inseparable. And because you are so solving a societal problem, it is also helping you, the model is also helping you to solve at least one or two key pain point of the sector. If that is not happening, you will not be able to scale up or raise money in the future. So both has to match. So to your question also with respect to what could be impact, if you are doing something to create impact which is not making business sense, right, you will either lose the impact as you go along, or the business will shut down. So example, I might be in agri supply chain, and I say, hey, I'm sourcing, let's say, potatoes from farmers, and the price is 10 and I'll pay 12 because I want to have higher impact, right? That will not work. The point is, how can you increase the value creation at the farmer level, where at the price of 10, where their margin was, let's say, 2, now they can sell at 12 because the value creation has happened at the farmer level. So that is how, and now your model is about value creation at the farmer level. So the moment you stop doing value creation at the farmer level, you can't have that impact. Now, because you are having a value creation at the farmer level and a higher margin for the farmers, for you to scale up or acceptability of your business also goes up. So it becomes a pull strategy where you don't have to hard sell your product.
Okay, okay, got it. Both of these have to be checked. Like you said, either it's a margin, like let's say a woman founder, or it's solving impact. So both have to be checked, or you would also invest in women founders who are doing something which has very minimal impact angle on it.
No, so we will not do, or we will not invest in a company which is just woman founder and not having,
Mm,
the impact thesis. We will not do it, just because of the founder being women. So both has to check for us.
and your definition of impact here is very clearly marginalized communities, like affecting marginalized communities. One could say that I'm building a platform for gig workers, and it's an impact that I'm creating. I'm allowing company like there's Squadron and a couple of other uh, platforms which allow companies to outsource work to gig workers. For that matter, urban clap urban company could also say that they are in the impact space. Would they qualify as being in the impact space, or
So for us, no. I mean, it might qualify for an impact space for somebody else. So us, there it's very clear. And when it comes to the whole gig economy or gig work right now, this is very similar to, I don't know, Akshay, you would remember there was this phase when BPO as a sector in India was booming, and
yeah, early 2000s.
every kid, yes, every kid was dropping out of college, not doing schooling, and going and joining a BPO. Good English and or good Hindi, good communication, you can earn anywhere between 15-20,000, which was a big money at that time. I believe a big part of the population, or a generation, big part of a generation, kind of, we lost a huge part of the generation at that time. So is when you talk about gig work, right? Because gig work, in a lot of sense, is denying workers their rights. So you did lot of progress with respect to worker rights and working conditions and everything. And this whole gig economy, which is a reality right now, a lot of those rights are denied. Okay, again, I can't change the market forces with respect to the gig economy opportunity which is there. But the company we are supporting, it if they are working with gig workers, then we have to see how are they changing the status quo. Are they ensuring with respect to social security, insurances, everything else apart from just providing that day's job through a platform? Because then you are doing more harm if you're not taking care of this, because a large part of the population is they will not have a career, right? It's all about then livelihood, and this livelihood also is not constant. It is kind of a daily basis livelihood. So we'll be doing more harm than good, because there'll be a time when a large part of population will be quite frustrated, because day in day out you have to do this and deal with the consumer, and the timelines are so tight. The ask is so crazy. So, and as consumers also, I mean, we don't want to pay. We talk about everything, but we don't want to pay. So it's also consumer are equally, we have to blame then the corporates, because it's the two forces kind of squeezing a large part of population in between. So for us, it is more important, a sector. We don't leave a sector saying, "Hey, this sector is, bad." We look for companies that can transform the sector. So is, for example, waste management, right? Waste management is a sector which is notorious for women exploitation and child labor. So does that mean that we don't invest in that sector? We have to actually invest in that sector, but find companies which are changing the status quo and work with them for longer term to bring about a necessary change in a particular sector. And so is gig economy.
can you give some examples of companies which you have invested in and how they reflect your thesis?
Sure. So I'll give you a couple of examples, one from the urban side and also from the rural side. So, from urban side, we are invested in a company called Miracle Couriers. They are into last mile for e-commerce players. Now, most of the people who work at Miracle Couriers are people with disability, and most of their delivery persons are deaf and mute. Now, if you look at so the thesis which I said, right, the business model has to be around a problem. So people with disability, they don't get livelihood opportunities. They're not hired in corporate. Now the founder here realized that last mile delivery don't need a lot of communication. Somebody comes to your home, rings the bell, leaves the packet or hand over the packet to you and goes away. There's hardly any communication that happens. So why do you need to have why can't you have people who are deaf and mute for this role now? So then if you look at the last mile delivery as a sector, you see that the sector has grown significantly over the years, but most of the companies are still losing money. It's a bleeding business as of now. A couple of reasons. One is, the large reason is attrition rate. The sector has grown, taken so much money, and then you have to all of a sudden have 100 new centers. So a lot of poaching happens, right? And the salaries has been it's not salary, it's per day based on the package for delivery boys have been increasing, so which is leading to squeezed margin. Now our thesis from the sector perspective is, in the longer term, be it Amazon or Flipkart, there will be product standardization, there will be pricing standardization. The one thing which will differentiate a Flipkart from an Amazon is the consumer experience, the quality of service. That is what will differentiate. Now when you look at this model, so this company have people on their rolls, so it's not per packet, so they have mix of salary and a bonus with respect to number of deliveries. The attrition, because you have people on the rolls and nobody is going to poach people with disability in there, because their processes are not set up like that. So you keep the attrition rate almost to zero when you have such people in your organization. Now unfortunately, these people have not got an opportunity, and there is this always, they are in their own mind, always forced, or they every day they're trying to prove that we are as good as you, if not better. So they don't cut corners. When for example, these e-commerce companies, they have 10, 15 parameters on which every delivery persons are assessed on a daily basis and recognized on a weekly basis. Okay, it's so high with respect to the performance, and these people don't cut corners. Unlike you have had your experience, I'm pretty sure, when you receive a message your package is out of delivery, and in the evening it says, sorry, you were not at home and we missed the delivery, and you were very much at home. They just logs in saying, because couldn't deliver today, they'll not do that. So those problems get solved. So consumer experience for the e-commerce company that you are working is high. You are solving the problem of attrition in the sector. So for example, a center for last mile delivery, and that becomes profitable at 1,000 deliveries per day, just for example, this company becomes profitable at 650 deliveries a day. So you are profitable at a lower operation level, and they have been profitable since we invested in the company. So they are solving a societal problem where you're giving opportunity to people with disability, and at the same time, because of your business model around it, you are solving sectoral problem of attrition and quality of service. So that's one.
Okay.
Another example from the rural side I'll give you is low cost. So this is a company called Avium Housing Finance. It's a low cost housing finance company. Now we
It's
see
like an
what happens.
NBFC.
It's an NBFC, HFC, yes, housing
Okay,
finance
housing. Oh
company.
yeah, HFC.
So
Okay,
yeah,
housing finance.
yeah. So they do like 3-4 lakhs kind of ticket size for housing loan. It could be for construction, it could be for renovation, it could be something else against the property. Now, whether you are doing a 3 lakh loan or a 30 lakh loan for housing, your cost of transaction remains the same. You have to follow a set process with respect to underwriting and documentation. So if the lower, so which is why you see a lot of housing finance companies, they usually tend up to go up the value chain with respect to ticket size, because that's where you are getting a better margin. Now, so this company is into low cost housing finance, but what they do is a lot of their sourcing happens through a network of women whom they call Aviam Shakti. These are not employed, but these are women from the rural, and they source transaction for the company from their own vicinity in the villages. So they know somebody, another woman for something they need, and they'll connect them with the company and get the login done for the application. So you're taking out a lot of cost with respect to having loan officers, and it's for the community, and within by the community, it's kind of you're getting the proposals. So that reduces the cost with respect to your underwriting or operations, and then the process remains the same. So that despite being at a low margin, so one, you are giving opportunity for livelihood or additional livelihood to the women in the villages, and at the same time you are solving the issue of lower margin when you are operating at a lower cost. They have had phenomenal growth in the last couple of years since we invested, and we partially exited from this transaction very recently. So that's another example of high growth company.
I was saying that this was a management buyout. The
No,
exit
this
was
was
partial.
uh, this was a financial buyout. So another big investor from Nuveen, from the US, invested in this company called Nuveen, and they gave secondary exit as well.
Okay, okay, okay. Interesting.
So this is the example of the third bucket I was talking about.
Hmm. Right.
Right. So
Okay.
here you are solving a societal problem with respect to livelihood in the rural India, additional livelihood for women, and at the same time solving the sectoral problem when you are operating at a low ticket size with respect to your margins.
Okay. Um, I'm just wondering. Let's take the example of, let's say, financial inclusion, and one could 10 years back imagine that the way to achieve financial inclusion is through some sort of socially minded organizations, but then something like a UPI and a Paytm has achieved that with a pure for profit focus, purely commercial organization, solved it at a scale which nobody would have imagined 10 years ago. um, these isn't the TAM very low of this, like like a logistics business which is employing people who are deaf and dumb? It doesn't sound like it could become big. I mean, the TAM itself seems low. I mean, how many deaf and dumb people would there be whom they could employ? What happens when they hit a limit? And I mean, as opposed to like say a Shadowfax kind of a platform which also does last mile, them starting an initiative where they start onboarding deaf and dumb people, or like I as part of the CSR initiatives, companies do stuff like that, so I'm just wondering that, are these really scalable businesses?
So, a couple of points there, Akshay. One, so if you look at just the population of people who are deaf and mute in India, that's 2% of the population, right? That itself is a huge number if you consider. Not everybody will be employed by the company. I understand, but see, it's all about inclusivity and diversity. So if you are able to grow to a certain level by doing this, and then you kind of start, you need to be diversified as well. So then you need to bring in people who might not be deaf and mute, and mix and match so that the whole ecosystem is created. So it could be other way around, where you have a company, which is what now corporates are looking at, where you have created such a huge company with respect to not being inclusive. Now whatever you do with respect to inclusive, that is not even 0.1% of your workforce, right? Here, what we have started doing is we started being more inclusive, and now you have people who are not deaf and mute, and then the organization is also growing. So it's both the ends which we are solving. At the same time, when a center is run, so that has other disabilities there, you would see women employed in the centers, well, all sort of other disabilities. So you kind of increase uh, TAM, as you were saying, with respect to workforce. So one is that not everything needs to be very big. right?
Mm.
So, and which is where our underwriting for these type of companies is. They might become big, they may not, but if they are cash flow positive, you have created an organization which will slowly and gradually create a lot of impact. It will also kind of showcase how you can think differently. We get an exit through management buyout and the founder continue to do good job. It might take 10 years, it might take 20 years, right? So it's
Mhm.
also kind of how do you seed something sustainably, which can have a very high impact longer term. As an investor, that's our job, right? How to help seed that particular opportunity, and not and which is why I say, that we are not a VC type of play. Not everything needs to be very big in 5 years. Something we have seeded today, if it becomes very big in 50 years, I think our job is done.
I understand. Yeah, so I was looking at it through a VC lens as opposed to a PE lens. Is how you're looking at it. I got it. Okay, okay. Uh, so this fund which you're currently raising of 70 million, you said, right?
Yeah, 75.
75 million. Okay. Uh, what is the current status? How much have you raised so far, and what kind of companies are you looking at, and how do you source good quality impact startups or impact focused startups?
So we are at a stage where the DD from prospective LPs have started. We are targeting to have a first close at around 40 million by first quarter of next year. Our existing investor, DGGF, Dutch Good Growth Fund, they are on board. There are a few other DFIs who are doing due diligence, few foundations, and Indian DFIs. So we are pretty sure we will be able to achieve 35, 40ish kind of number for the first close. With respect to sourcing of the transaction, so we have been very cognizant when we source deals. We try to stay away from the investment banking network that usually exists, because it's the same type of deals that you receive. They don't distinguish what's your thesis with respect to how you think. So you end up getting a lot of VC type of transaction. In our first portfolio or first fund, we don't have a single company which has come through an investment banker. So we source a lot through our proprietary network. It could be our founders, lawyers. We work with other advisors. We go out in the market and tell people, hey, this is what we are looking for. So for portfolio construction also, we try to have a we some understanding what we will do. For example, I'll tell you, inclusion. So we want to do something around another opportunity around housing finance. We want to do something around micro enterprise lending. So that's another area we are trying to source ourselves. So we do research and we find companies, and we don't have any issue writing to them saying, hey, this is an interesting model, and we are going to explore if you are raising money. Similarly, we know on the waste management side we are going to get some exposure, be it electronic waste is one area that we would like to explore. So we have those preferences, and we try to proactively source transaction from the market. Some of the deals, interesting deals that we are looking at apart from these, one, we are looking at a company which is into skilling, training, placement of people with disability. So they help corporate become more inclusive and diversified, and they identify people, train, and they also keep the people in their roles as an outsource team. Once corporates see that, hey, everything is working fine, they can bring them in house. That becomes a recruitment process. Then again, would it be a very huge company? No, but again, these are something which is helping. If they are able to help 100 corporates, 200 corporates to become inclusive, the systematic change that you have brought it in the sector will be high. This will be again a cash flow type of underwriting. Would there
Mm.
be a strategic buyer tomorrow coming and buying us, or not necessarily? Would we be able to do a management buyout? Definitely, right? So a lot of these type of transaction also we are looking at, which are working for systematic change, and we understand that will take a lot of time.
Okay, I understand. My last question to you, you know, do you have any advice for a founder who may have an idea to do something in the impact space? Any advice for how she should think about building? What stage should she come to someone like you? Should she come to you once there's already some revenue, and how should she navigate that 0 to 1 journey? And
Yeah, see, for us, we typically come in after a year or 2 years of operations. We are not a seed investor; we are post-seed investor, where the traction for the business is proven, and you are looking for early growth capital. You may not be
what
profitable.
kind of top line, like say, couple of lakhs per month kind of revenue,
So
or more?
usually, I would say 10-ish type of lakhs of revenue per month.
Okay.
So we, because see, our minimum check is 4 crores, is what we write. That's the minimum check size. So at least having a crore or two of revenue helps with respect to valuation and dilution. Otherwise, it becomes a challenging task. If we had the ability to do below four, then or there are investors in the impact space also who does below four. So for them, you can go there, but for us, it is a couple of crore of revenue. Uh, the advice which I'll give is, with respect to how you are thinking about the business, because we have seen a lot of companies, as I was saying, when you need to understand what is the innovation in the business model. Technology is required everywhere. Don't make the technology the hero. The hero has to be your innovative business model, which is woven around a problem, and it should be inseparable. If you are trying to do anything which don't make business sense with respect to impact, you will lose either of the two. And also think of how is this model solving at least one key pain point of the sector. Otherwise, scalability is going to be an issue. So these things need to be put in place rightly with respect to investing. Because a lot of companies, I'll tell you, come to us and saying, "Hey, you are an impact investor. Why do you talk about valuation or return or exit?" That's another area you need to understand. It's investing end of the day, and don't have a story which is just impact, or don't have a story which is just financial return. It's all about how you can balance the two.
And that brings us to the end of this conversation. I want to ask you for a favor now. Did you like listening to this show? I'd love to hear your feedback about it. Do you have your own startup ideas? I'd love to hear them. Do you have questions for any of the guests that you heard about in this show? I'd love to get your questions and pass them on to the guests. Write to me at ad@thepodium.in. That's ad@thepodium.in.